Hello, this is Jordan, and this video is being recorded on Friday, January 28th, 2022. Thank you so much for joining me. Please like, comment, and subscribe if you're watching this on YouTube. And in this video, I am going to discuss what is going on with, in particular, the gold market here with respect to what's happening in the stock market, in the bond market. And I'm really only going to focus on the bond market here because it's the biggest market, therefore it's the most important market in my opinion. And what we see going on, I think the real big thing here is there in yellow, which is the yield curve. That's the spread between the 10-year and 2-year. There's other people who look at lots of different spreads. You have some people who look at the 2-year versus the 30-year, the 5-year versus the 30-year, but we're looking at the spread between short rates and long rates. And when the curve gets inverted, in other words, when short rates become higher than long rates, that has almost, I think every time except once, it's preceded a recession. So it's a very ominous signal that everyone is aware of. And so in this chart, I have a lot going on here. We have the 2-year at the top. That's a proxy for the Fed funds rate. They generally follow that. Then you have the 10-year. Then we have the yield curve in the middle. Then we have gold. Then we have real yields at the bottom. That's the real 5-year yield, one measure of real interest rates. And so what's been happening is the 2-year has been surging with respect to Fed comments and also the anticipation that the Fed is going to be hiking rates. And so the 2-year is all the way above 1%. So I think the market is priced in 5 hikes for this year, which seems excessive. And so the 10-year and long rates have been going up a little bit, but obviously not as much as the 2-year and short rates. And so because of that, the yield curve, the difference between the two, you can see there, it's really diving. I mean, at one point in early 21, it was above 1.5%. It's been basically going down since then steadily. Now it's down to, I think today it's 0.61%. And generally, I mean, this is what happens. The market or the economy, as a recession is happening or as it gets close to a recession, the Fed cuts rates aggressively, so they want to see the curve steepen. And, that's around the time you have a recession. And so they finish cutting rates and usually get a recovery, and then the yield curve will start to decline or flatten. And so that's what typically happens. As it starts to flatten, they hike rates, and then eventually when it gets to zero or very, very close to zero, if they have room, they stop, and then they start cutting rates. And so obviously this is a different economic cycle, but the problem is if you look at where the spread was, the yield spread between the 10 and the 2, if you look at where that was in past cycles, when the Fed started hiking interest rates, I mean, it was much higher than it was now. I mean, they haven't even started yet, and it's at 0.6. I mean, for example, if we go back to just the last cycle, we look at, that first rate cut at the tail end of 2016, the yield spread was around 1%. And I mean, that was an extreme cycle. So this is an even more extreme situation where it's there's not that much room between zero and where we are now. And so, I mean, hindsight is 2020, but obviously the Fed should have started hiking rates a year ago. And at this point, the talk should be about, well, they've been hiking rates and when are they going to stop? Probably at some point this year. And so that's really where we are. And if we look at 2 of the last 3 cycles in terms of rate hikes, there was only a 6-month period between their last hike and their first cut. Just go to the last cycle, December 2018, last hike. Then they were already cutting rates in, June or July of 2019. So only 6 months. And with the way things are shaping up right now, I mean, it looks like that time between the last hike and the first cut, I mean, could even be shorter this time around. I mean, we could see a cut if current trends continue, I mean, we could perhaps see a rate cut, at the very end of this year or early next year. And so the real key is if the yield curve continues to decline or flatten towards zero, when that happens, the Fed is going to stop hiking. We can see, I mean, if you look at this chart, I don't need to talk you through it, but if you look at the vertical line, the red line, that's the last hike. I mean, look at what happened going back the last 3 cycles. And the thin black line, that is when the curve inverted. So we can see in the last 3 cycles, around the time the curve inverts, especially the last 2, look at, if you look at the last one, they stopped. The curve was very close to inverting. It eventually inverted. And then you look at the mid-2000s, the curve inverted, and then they did their last rate hike after that. Same thing in 2000. I mean, I guess this time around, if you look at the last cycle, the curve inverted after they stopped hiking. So if they follow that, I mean, they might have to stop hiking really, really soon. Because they'd stop hiking, the curve would invert, then they would start cutting. So, I mean, that's why some people are already talking about rate hikes at the end of this year, early next year. Now, if we look at the bottom and with respect to gold, I mean, some of the interesting takeaways are, number one, I mean, we know that gold traditionally, historically, almost all the time, it's put in a bottom when the Fed starts hiking. So we look at the technicals of gold. Gold is looking like it's going to break down. It failed to break out. If we look at the performance of the stocks, I mean, the weekly charts are really ugly now after the last 2 weeks. And so gold, we have that scenario of testing the 40-month moving average, or equivalent to it. That's 1640, 1650 now. Maybe that's at the end of March or April, perhaps. And, if it puts in a bottom at that point, I mean, that's aligned with history, because when they start hiking, that's when gold usually puts in a bottom. And again, historically, major significant bottoms occurred when the Fed started hiking. And so this coming bottom in the next, 2 months or so, it's shaping up to be a historically significant bottom. And, last thing here, if we look at the bottom, that's the real 5-year TIPS yield. And I also, if you look at 2000 and 2001, I kind of penciled in, I just looked at the real Fed funds rate. And so the real Fed funds rate peaked, I think, November 2000, right after the Fed did their last rate hike. So this is another key takeaway. And look at 2006 and 2019, and you can see, the mark of real yields, and that around the time the Fed has executed, at least recently, executed that last rate hike, that's when real interest rates tend to peak and then roll over. I mean, it makes sense because then they're moving towards cuts. So that's very interesting. But, let me give you my conclusions here, because I'm babbling a lot. But these are really the important takeaways. Number one, the yield curve is diving. I mean, diving towards zero. If you look at 2s, 10s, 5s versus 30s, 2s versus 30, anything, it's flattening aggressively. It's diving towards zero. When it gets really close to zero, the Fed will stop its hikes. So it stops its hikes, I should say, around inversion. And as I just said, real interest rates peak when the Fed stops hiking, when they do their last hike. And so what does that mean for gold? Well, number one, we've already talked about it. Gold bottoms when the Fed starts hiking. And if we look at the last 3 cycles, gold accelerates or really moves and outperforms when the Fed stops. And so this cycle, it appears that it's going to be, somewhat similar to the last 3. We're not in a cycle where inflation is going to accelerate and the Fed is going to hike and inflation is going to keep rising. That's not going to happen in this cycle, in my opinion. That will happen in the next cycle. That'll be end of 23, 2024. Because in this cycle, Growth is coming down sharply. Inflation is going to come down significantly. I've talked about it in recent videos. And so it's not going to be a cycle where they hike rates and they have to chase inflation. That's going to be the following cycle, not this cycle. So we're basically setting up for a couple of catalysts this year for gold. Number one, in a couple months, the Fed does the first hike. Looks like gold could bottom then. Going to be a historically very significant bottom. And then secondly, gold will really accelerate when the Fed stops hiking. And so who knows? Maybe they do a 50-point hike and they do a hike in May, and then that's the end of it. But the time between when they start and stop, that's going to be pretty short. So look, the charts are really ugly in precious metals. Gold could break down below 1750, but we're heading into a major bottom here. This turmoil, it always hurts gold, at the beginning, but it always turns out to be super bullish. If you look at every major bottom, I was looking at GDXJ and just, the last three bottoms, and I even looked at the bottom in 2005, which was really significant. I looked at the MVIS index, which is based on, or which GDXJ is based on, and I was putting this out to subscribers last night. I mean, all these major bottoms, GDXJ in like the 2 months before it happens, 25%, 30%, 20% type of decline. So this is really painful right now. I have good amount of cash, but I'm fairly invested myself, so I'm feeling the pain with you. But I'm not worried because I've seen this before. I trust my analysis of all this, and I'm very confident we're going to see a significant bottom, and that gold and gold stocks, and then silver will follow that. That is going to be the place to be after the first quarter this year. Leave a comment. Let me know what you think. Got a lot more coming. Got some potentially great interviews set up at the end of next week. And follow all my work at TheDailyGold.com. Find out what stocks I'm going to be buying and adding to in the next couple months. Thank you, and look forward to doing another update for you guys.